15-minute time frame. You can see it on all time frames, but really 15 in 1 minute, if you do it over the course of a week, you'll see how price gravitates from a full figure. Okay, and that would be an example of like 117.00 to 118.00. That would be a full penny move in the euro dollar. That 1 penny move is broken down algorithmically to the 117.80 level, 117.50 level or mid figure, 117.20 level, and then we have 117 big figure. Okay, so my question to you is this: if price traces above it, this old high back here, because we broke through that, this high is 117.14. So from an algorithmic standpoint, what price level would it want to reach back down into if it's going to go down for support? 117.20, because it's just above the 117.14, right? So if this high would have been 117, say 65, what would the level be that you'd expect to see it reach down into for an algorithmic support level? 117.50, mid figure. Okay, so think in terms of that. Okay, and what this does is it eliminates all this distraction. Okay, looking at ladders and depth of market and all those types of things. You can probably swear by it and tell me you've done really, really well, and that's great. Just like anybody else using crossovers and MACD, they can tell me they've done really well with that too. I'm not telling you that you can't make money doing that kind of stuff. I'm just simply suggesting to you there's a much easier approach to doing this than everyone's doing. So we're using an old high here, and while the level is 117.14 and the specific high, from an algorithmic standpoint, we would look for sensitivity or support to form around or at 117.20. Okay, so we're going to leave the level here, and we're going to drop down into a daily. Okay, so we have the 117.14 level on our charts. And now I'm going to ask you to consider what is going on in reference to the institutional level from an algorithmic standpoint. In other words, we looked at our pricing model. It's full figure, above it, the 20 level, above that, mid figure 50, above that, the 80 level, institutional, and then we have the next full figure, okay, or 118. So if we're above price, when it trades above it here, we expect to see price find support when it comes back down into the 20 level. Okay, so now we can adjust this level here and show at 117.20. Okay, so 117.20 is the institutional price level. From an algorithmic standpoint, price is going to want to trade back down to that level. The reason why it does that is it allows the market to pick up orders at just below or above that level. Okay, there's limit orders there, there's stops there, but generally it's coming down to run stops to pair the orders with smart money's limit orders. Okay. Every time you see my chart below the market, I'm always referring to it as running sell stops. Above the market, I'm always referring to it as running buy stops. Those that are not in the know, they will question whether or not I'm using the right definition. I am using the right definition because I'm looking at things from an institutional standpoint. Those sell stops that are below the marketplace, smart money will have their buy limits to pair up with those sell stops. Okay, so my perspective is not retail. So I'm looking at it from an institutional standpoint. From where I'm from, I don't look at it retail. So if we understand that the market is above this 20 level, when it trades down into it, we should see the market trade into a support level. That support level is going to be defined by some pricing model, and I just gave you one that's very simple. We used the old monthly high, and we're finding support. We want to see price trade off of that and give us a pattern. So now we have a level. It's been rounded to an institutional level 20, 1720, and now we can drop down into lower time frame charts, and we'll just look at a 15-minute time frame. Okay, and then we'll there we are. All right, so we have price trading down on the 27th and hitting the 20 level. Notice what it does. It hits it and then rallies away. That rally, this is what you're looking for. You want to see it take out a short-term high. That is seen here. You have a short-term high. It trades through it. Once it does that, this break above that short-term high is a market structure break. Okay, so now from an algorithmic standpoint, the price will want to retrace back down. Once it retraces, okay, it's going to pick up more orders and then rally again. Okay, we have another break above this short-term high here. And I'm quite certain you guys that are more proficient with TradingView, you're probably smiling saying he could have done this or that and just made a copy. I don't know all that yet. So just give me some time. So we have another break here. Okay, so we have short-term high broken and another high broken. Now watch this high being higher than this one from a market structure standpoint, short-term high, intermediate term high. So now when this breaks here, we have a much more solid setup for a potential run and price higher. Now we have to enter the optimal trade entry because we already have a consolidation in here. Price trades away, came back to the consolidation, distribution, redistribution, smart money reversal, low risk buy. And here we're looking for another area to buy, okay, or another area of accumulation or reaccumulation to take us above this consolidation. Now, what I just described to you is a market maker buy model. It's simple as that. Some of you will say, oh, that's Wyckoff. Well, I kind of got the idea from looking at price action alone, and then when I saw Wyckoff describing that scenario, it made me feel better that I seen something that someone years and years before me was able to see that same price structure, but his definitions and things, I don't use that. There's a different approach, and folks that went through my mentorship know right away, and I've challenged them as well to go through Wyckoff and see if what I was teaching was Wyckoff. It's not. It's very similar in terms of the general market profile itself because it's a very generic process. Markup and discount. It's simple as that. But the long and short is the run above here, right there, that impulse leg is all that's necessary because now we have a buy profile